The time when we have to get worried about this is when the consensus take is that semiconductors aren't cyclical anymore. But I don't think we're there yet. To be honest, Nvidia is still killing it. They have a $4 trillion market cap. Could it go to 8? I don't know. Maybe.
Today's episode of Monetary Matters is brought to you by VanEck Semiconductor ETFs. Later on, you'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and their newer VanEck Fabless Semiconductor ETF, ticker SMHX. Let's get into it. Today, we've got a very special episode. I am joined once again by the trader, speculator, writer, publisher, investor, known only as Citrini. We got a lot to talk about. James, you were very early into AI. Probably that's when we first did our interview 2 years ago. Talk about phase 1 AI. That basket has performed extremely well. We've had some hiccups in January and February, and March and April with AI. I want to know how you are thinking about it. And first, I want to tease, you just put out a publication on robotics. It's actually your second piece on robotics, and it's like kind of the next phase of AI and industrial automation. And you specifically name a company, and you like that company. And almost instantly after you publish, Goldman Sachs put a sell rating on that company. And it'll be interesting to see who's going to be right on that company, Goldman Sachs or Citrini. But we're going to be talking about that much later on. First, James, talk to us how you're thinking about artificial intelligence right now. Where do you think the winners are going to be? Is it time to sell? Is it time to put down risk? Just how bullish on this theme are you thinking, and where within the theme?
So AI has gotten more difficult. It's just a fact of the matter that when strong themes like this start out, you're looking at an environment where typically the best themes typically start with bottomed out cyclical nature of an industry, right? So we saw that with semiconductors. And when I first came on the podcast, back when you were on Forward Guidance, the kind of controversial thing that I think there were a lot of people that understood that Nvidia was doing AI and that was good for Nvidia. The controversial thing that my take brought to the table was the idea that this was much more broad, right? This would be something that would be good for a large swath of the semiconductor industry and beyond the semiconductor industry, beyond interconnects, just data center build out, infrastructure, power and energy, that kind of thing. So that was when it was easy. It was, you just bought the companies. Nvidia was trading at a ridiculously low multiple. There were so many companies that had upside to this build out. And if you just had the imagination to say, this isn't just people buying more GPUs, this is people retrofitting and transforming the data center landscape to do AI. That was a layup, and it was, if you truly believe that, it was very difficult to underperform. Now you're getting to the point where you have to have a little bit more of a nuanced view. You have to start thinking about, I would say we're in like the 5th or 6th inning, right? Where you're constantly a little bit paranoid about, is this going to end like the fiber build out in the dot-com bubble? Do I really, like in the beginning, the picks and shovels infrastructure stuff had a pretty significant margin of safety. That margin of safety has certainly gotten a lot more narrow. So what I've been looking for, and like I said, this is more difficult, so there's more opportunities to be wrong. What I've been looking for is, where are the beneficiaries of the actual implementation of artificial intelligence, of machine learning, of this massive infrastructure build out that is being done or is done in some cases. There's a couple ways to look at it. And if you're on the purist side, your kind of thought process is, this goes until we get AGI. And in order to get AGI, you're going to have to build these massive power hungry data centers, and the power will become the bottleneck. And that is something that we're seeing play out. But also, to a degree, on the other side, you have to say, can we really infinitely fuel this until we get to AGI? Or even if we don't get to AGI, we have to make AI a useful product, and we have to start seeing ROI. Or else the great thing about this, and why I remember when we first did our podcast, the AI thing was just, is it a bubble? And I think my answer was like, it certainly can be. But the thing about a bubble is, like, bubbles form when earnings aren't going up or revenue isn't going up as much as the stocks are. I think the way to insulate yourself from that risk is to start really concentrating in companies that have the potential and have more forgiving valuations in the actual implementation of AI. This was always the way that it was going to go. So I'm really focusing in, now that we have made these advancements in AI, which we have, how are they being used? What are the bottlenecks that their actual implementation is facing? Like, where is the alpha in actual companies doing this? And something that we've touched on has been AI agents, but then the kind of more interesting phase 2 of AI is in robotics, which we presented as humanoid robots. And to be perfectly honest, and you get this immediately if you read the article, the primer is called humanoid robots just because it's super sexy. Everybody wants a robot doing their laundry or doing their dishes. If you actually read the article, the takeaway is much more like humanoid robots are cool and they will be here eventually. In the meantime, advancements in what's called vision language action models, like LLMs, but more for integrating sensor and perception data, have made it so that we can really unlock a huge advancement in automation in general, right? Whether it's the robots delivering your DoorDash or Uber, or like the industrial process automation. So the real kind of upside here starts from the fact that there are very few cycles that still look like how Nvidia looked like at the end of 22. One of those cycles is automotive. Once you see a sector where there's a real fat tail from an innovative technology, and the thing about these cyclical industries, and you always see it, is something bad happens cyclically, the industry enters a downturn, and then for about 6 months or a year, everyone tries to call the bottom. And in the meantime, the analyst expectations go to being cyclical cynicality or cynical
cynicality.
The thing about that is just analysts start feeling like this is how it's going to be forever. So a really good example of this is the stock which you mentioned we just wrote about, right? Teradyne, if you look at it on the last 12 months basis, you say, okay, I don't know if this is like a semiconductor testing company. It's got a lot of auto exposure. It's got a lot of exposure to these kind of lagging edge chips that aren't really that sexy. And the end markets that it touches are not in a great place. And it trades at 20 times EV to EBITDA. I don't know if I'm interested in that. But then you look closer and you say, okay, if it returns to how it was in the last upcycle, it's actually closer to 7 to 10 times EV to EBITDA. And that's super attractive to me. We teamed up with investigative reporter Hunter Brook Media, and because there was a video that Amazon released that really caught my attention. It was like, there wasn't a lot of, the reason why we framed it as humanoid robots was because it's very difficult to get super excited about automated robotic arms. Not everyone works in a factory. Not everyone's, oh man, awesome, the arm is going to pick this stuff for it. It's a lot easier to understand the way you could get excited about, God, I hate doing my laundry. So really, when you look at the Vulcan robot, Amazon's robot, which is part of a larger trend, Amazon actually is close to having more robots working in their warehouses than they have humans. And this is not a new thing. It started with their acquisition of Kiva in 2012, I believe. But the Vulcan robot, the arm, if you think about one of the biggest kind of challenges to automating the process of taking an item, putting it in a package, picking it, putting it in the right place, you have to have a little bit of a different approach if someone's buying like a Fabergé egg versus if like Anthropic's vending machine model is buying a bunch of tungsten cubes, right? And part of that is the tactile sensation, right? A human can very easily tell, if I squeeze on this, it's going to destroy it. And if I handle this in a specific way. So that's the advancement that happened with Vulcan. And the most interesting part of it was there was an employee of Amazon Robotics that worked, I believe, at NASA, PhD, and presented it as, I was the guy in the meeting saying, you guys are chasing up the wrong tree. This is never going to happen. It's just, and he explains how he goes through like seeing the breakthroughs in vision language action models and realizing that it's actually possible to do this. And this opens up a whole new, it's not just sensing and perception. It's like moisture sensing, it's any sort of sensing, even stuff that humans can't do, can be integrated into these robots because of the advancements in compute and because of the advancements in the brain. So we saw this video, CNBC did a 12-minute clip about this new Vulcan robot. And in one of the clips, the guy's standing next to one of the robot arms. And if you zoom in, and you probably see in like Law and Order where they're just like enhance, in hand. Like, I'm not doing that, but someone is. So you can see the sticker says Universal Robots, which is owned by Teradyne. And once you get down to the math of it, when you say, okay, how many people are working in pick and stow? How many robots could possibly replace this? How much do these robots cost? You start getting to a pretty interesting, like, evaluation of what the potential market is here, just focusing on the Amazon contract, where these robots cost about $150,000 to $250,000 a piece. And if you estimate about 5,000 of them are going to be used, you eventually get into the very conservative estimate that this can increase Teradyne's revenue by like $400 million, maybe add about a dollar to their EPS. That's like a big deal. And the kind of more qualitative aspect is Amazon isn't the only company running warehouses. So once they see Amazon has always been the trailblazer in logistics and shipping and this kind of massive behemoth that leads the way. And you would expect that once they have some success and they're able to improve on it. Right now, this robot only has, it's like crab claws, like grippers. But dexterous hand technology is getting better and cheaper, and especially in China. So that can grow pretty significantly. And then you come back to the original thesis of this is a cyclically screwed company, and they've got this massive robotics tail, and nobody really cares about it. Teradyne's trading, I don't know, 20% off the 52-week or maybe even 3-year lows. And that's super attractive to me as an investor. So that's what I'm trying to focus on. And that's why we like literally went to China, because a lot of this robotic stuff was happening in China, and just visited like Unitree, who's making the $16,000 humanoid robot. It doesn't seem exciting when you're there, right? Because you're just like everyone's super stoked about, check out this screw. And you're like, wow, that's a screw. But it's like, but then they're like, the screw used to cost like $3,000, and now we're doing it for $300, and you're like, oh, that's a little bit more interesting. And so that's what we're focused on. As the second phase of AI has a meaningful way to start touching the real world, right? Like the physical world. And you think about it in the way that you think about how the internet progressed. And I don't know if you remember, how old are you, Jack? I forget.
I'll tell 28.
Okay, yeah. So you might remember, so when you were like a freshman in high school, you were still like, we were still experiencing the thing where someone's, yo, check this out, I just bought it on the internet. And you were like, you bought it on the internet, you idiot? They're going to take your money. What are you doing? And there were a bunch of companies that like PayPal, a big thing about PayPal in the beginning was like, oh, wow, I can put my credit card information on the internet and know that it's not going to get stolen. And then the next kind of big thing with the internet was like when people started having the genuine thought process of, I could go to the bookstore, but maybe they won't have this book, and maybe I could get there next week, or I could order it off Amazon, and then it will be at my front door in 3 to 5 days. And Amazon optimized for, let's get this down as much as possible. And you got like prime shipping, and so that was where the e-commerce stuff started coming into the real world, where people just felt almost more comfortable with the internet as a means of transaction. And I think that's what needs to happen with AI, right? You can never force a zeitgeist. So you look at what Google is, this is super interesting, and I still can't necessarily figure this out, because I Googled something the other day and I got my answer and I didn't see a single advertisement. So that's a whole other can of worms about how AI affects the advertising industry. We can talk about that later. But what we really need to happen is AI needs to become second nature, the same way that ordering something off Amazon has. And I think that robotics is a big way into that, where it becomes normal to order something off DoorDash and it shows up to your door in a little box, cooler, heater thing that just delivers your food. And really the thing is, like, the sensing technology's there, the hardware's there. But the only thing that has been holding this back is the brains. And because Nvidia has made these huge strides, we're really seeing the possibility where it'll start out in these structured warehouse-like environments where you can just upload a digital twin to the cloud and you can train, here's how everything's laid out. And then it'll move towards, okay, now the software is good enough to know whether we're on the sidewalk or not. And maybe now the software is good enough to transverse totally unpredictable terrain. If you go to the primer that we just wrote, you can see a video of Unitree's robot dog, which is maybe the scariest thing I've ever seen. Why this thing is a wheeled dog that can go 30 miles an hour like nothing and can climb stairs. And dude, watching this thing climb the stairs, you're just Terminator might have been a documentary. So that's a big part of what I'm focused on. Obviously, there's still a long way to go with it, but in terms of where the most attractive kind of longer term opportunity is now, Nvidia is still killing it. And when it comes to the rest of the semiconductor industry, it's not like there's not great opportunities. It's just it's gotten a lot more hard. It's gotten a lot more difficult. And if you look today, like Amazon is creating its own liquid cooling system, and how does that affect Vertiv? And like that was not something that was happening a couple of years ago. It was something where it was very easy to discern first mover advantage. It was pretty easy to discern who already was positioned properly for this. And now you just have to, you're back in the environment, which can present a challenge of just outperforming requires imagination.
And what's your overall outlook on let's just say those phase one names, the semis?
You got to give me a time frame, like just so that I can be wrong in the correct way.
A year, or you choose and say it.
Okay, so a year out, I think a year's a pretty short period of time. So I think like when you're talking about a year out or a couple quarters out, it's really a lot more about price and valuation and the base that you're coming off of versus longer term opportunities. So what's really interesting to me right now in terms of like the next 12 months is these kind of like wide band gap names. So a big part of what we've seen in the data center, and this also affects robotics and it's also affected electric vehicles. And because it's affected electric vehicles, these names have traded like absolute dog shit. But the challenge is basically you want to run as much energy through something without just frying it. You don't want to turn your capacitors into radiators. Really, there's like silicon might not be the best way to do that. It probably isn't actually. And so you look at other substrates, they're called, basically what you're putting the chip onto. And there's interesting developments in what's called silicon carbide, which is abbreviated SiC, and then gallium nitride, GaN. There's a whole supply chain for these, but you just saw a Navitas enter into an agreement with Nvidia, and this is the same kind of issue that's affecting robotics as is affecting the data center. So I think the chips that are similarly exposed to a kind of negative cycle that might be bottoming, the power and energy chip names are pretty interesting. On Semi as well, Infineon, even Texas Instruments, these kind of more lagging edge stuff. I think that could outperform in the short term, just because it's coming off a more forgiving base. And obviously, this is it's a little bit more economically sensitive. Don't get me wrong, semiconductors, no matter what, are still stay cyclical. That's the time when we have to get worried about this, is when the consensus take is that semiconductors aren't cyclical anymore. But I don't think we're there yet, and a lot of these are acting super cyclically. And so that's one interesting area that I think we could see outperformance in semis. With Nvidia, it's like the Soros quote of, "I'm not a security analyst, I'm an insecurity analyst." It's time to be an insecurity analyst on Nvidia, and that's what I've been doing. But in early January, before the DeepSeek freak out, sold Nvidia just because I'm not clairvoyant, right? I see the information as it's presented to me, and then I want to make sure that I am least exposed to the risk of this going the worst possible way for a stock. So sold Nvidia in like mid-January, avoided a bit of a drawdown, started doing the work on robotics, saw the fact that it's always interesting when you're really familiar with the company's aspect in a certain aspect, right? And when it comes to AI semis, and then you start researching something that's a little bit, and it just keeps coming up. It's, oh my God, Nvidia owns this, and they have investments in this, and then they have this Isaac Sim, which is like the dojo from the Matrix, where you can just upload a digital twin of a robot, and it can train 1,000 hours in the span of a weekend. So I bought back Nvidia and benefited a little bit from the tariff freak out, and that's how I'm thinking about it. It's just, this is a fast move. Technology is always fast moving. If technology is ever not fast moving, that's when you really have to be scared. Like, you look at what's happened to software names, like that area has become a little bit less fast moving, and that meant you have to be super selective and super paranoid about the next negative catalyst. But to be honest, Nvidia is still killing it. So they have a $4 trillion market cap. Could it go to 8? I don't know. Maybe. Like, it's just the other area is it might be AMD's time. I don't want to say. I think the fact that I don't want to say that publicly, even though there's like a lot of evidence that it is encouraging. And then also another area that's pretty interesting is kind of these like contract manufacturing PCB specialists like Celestica, TTMI, Jabil. They're again, the next leg of semis over the next year is basically just a function of how good is the economy. If the economy is good, there's a lot of upside and a lot of names that have traded off on economic fears. In the longer term, that's when you get into what does the data center look like in the future? Who makes their own stuff and who loses out? That's a little bit more difficult to predict. And to be completely honest with you, when the market's at all-time highs, I'm less. That's something that you want to focus on when the market's in what you think could be a generational bottom, right? Because then you're looking at, okay, what can I buy, forget that I own for a decade, and then be very happy about? So yeah, that's my short take.
Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack from design to manufacturing. Historically, this unique construction methodology has helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHJack to learn more. Using a similar philosophy, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHXJack to learn more. And now back to the interview. And why kind of like everyone is looking for AI exposure to semiconductors outside of Nvidia. The way it seems to me is that everyone is looking for AI exposure outside of Nvidia. And it seems to me that they're looking at companies whose earnings are going up way less than Nvidia. And they're saying, maybe this could be the next Nvidia, but it's like Nvidia is the next Nvidia.
It's so funny to me because I don't know if you remember, like, that was what we talked about in June of 2023. You remember, like, the biggest pushback.
Yes, you said that. You nailed that.
The biggest thing was when we did that podcast, everyone already thought that Nvidia was overvalued, right? And it was like, and then it was just like, it was like shooting fish in a barrel. It was like you could buy Fabrinet at 3 times earnings or whatever, or Arista or Celestica or Credo or any of these, like, really not pricing in at all the tail from AI, and everyone was just focused on what they thought was an expensive valuation for Nvidia, right? Nvidia now it's the biggest company in the world, and listen, it's amazing, and I own it. Am I gonna make Nvidia 100% of my portfolio? And when we did that first podcast, Nvidia was 25% of my portfolio, and that's come down and down because, like, you come up against just the law of large numbers, right? It's when you become a company that has a market cap that big, eventually you are exposed to just, do you become like GDP plus? And yeah, the plus aspect can be pretty big, but it's always funny when I talk about, hey, what about these names like Delta Electronics or Alliant or Texas Instruments or Infineon, and people are like, oh, too economically exposed. And it's like, dude, Nvidia is the economy now. Like, you're telling me they're not economically exposed? So it's interesting because that was the thing you didn't have to care about 2 years ago. I think it's prudent to care about it now. And I think the economy is doing well. Services disinflation is more than offsetting like any tariff goods pass through on inflation. You got a big kind of catalyst to consumer spending from the tax bill. I still don't really know what that deregulation leg of the Scott Bessent's three-legged stool. He's got the trade policy, so we know trade policy, we know the tax policy. I still don't know what the deregulation looks like. Is it a banks thing? Is it anyone can get a bank charter? Is it mostly crypto? Is it like we're going to find that out over the next 6 months. So that's another positive catalyst. So the economy is doing pretty well, and rate cuts are going to happen eventually. especially once you get to Trump Powell's end term. So it's focusing now on just, yes, I want to own some Nvidia, but really, if the market's going to rip, I want to be exposed to stuff that has underperformed because people are worried about the things that they're not going to have to be worried about anymore. One thing that I'll just say about playing these big technological trends, if you are someone who cannot abide feeling like you look stupid, you absolutely should not. You should stick to other things, because you will look stupid and you will feel like you're being stupid. And the thing is, when it comes to like innovative trends about the future, if the idea doesn't feel stupid at the time that you have it, everyone else would have it too, and it would already be priced in. So you have to go out on a limb on stuff. And the way that I make myself comfortable with doing that is by having kind of a macro informed approach. That also can be wrong. But yeah, so that's how I'm thinking about it. I think it's so fascinating as to see the feedback of, you start talking about AI in 22, 23, everyone's already convinced that Nvidia is in a bubble. And now the dominant narrative is just like, why don't you just own Nvidia? And it's, yeah, of course Nvidia can continue to do well. There's also a lot of companies that are 100x's over the past 50 years that can also continue to do well and have a lot, like Amphenol.
Do they make the screws?
Amphenol?
Yeah, no.
They make a bunch of stuff. Basically they do like sensors, optical products, and then they aren't so much the actuator hardware stuff, which we can talk about later. They're not like the screws and there's some US names, there's some EU names, and then China is like the upstart in that. Amphenol is much more about like interconnect solutions and sensors and cables, and so they have a data center upside as well. But yeah, so anyway, that to put a point on it, I think that this is a very easy time to get complacent with stuff, and it's super easy to get complacent when the market goes up and your holdings also go up. But if you're like, I try to be more concerned about generating alpha when the market goes up than when it goes down. I'm okay with taking one correlation drawdown when the market goes down if it means that I can outperform pretty significantly when the market goes up. And I think that to do that, you have to own some things that not everyone else is comfortable with owning.
And so the last time we spoke in an interview, James, was right before the DeepSeek moment when Nvidia was down 60-70% in a day because China figured out this way to not use that many Nvidia chips, so there won't be that demand. And no, it's now about inference. It's not about the other thing. How seriously do you take that thing, or is that not a threat?
It's a threat, right? Like the probability of it being realized as a threat is something that it changes, right? The more that you align your thought process with the way that the market, if you can think like how the market thinks, but a couple weeks or days ahead, that's the perfect place to be in, right? So when DeepSeek comes out and the narrative is they've used less chips and they have the data to back it up, and like, okay, well, they did train it on Nvidia chips, but are there real advancements here in terms of open sourcing? And at the same time was a little bit worried about like the ASIC angle. You just say, I would rather not take that risk right now. I'd rather have more information, because even the smartest people in the world don't have the full kind of picture of what this looks like in a few months. And then as the picture unfolds, as long as you're on top of updating your understanding of what that picture looks like, chances are you can probably end up buying it back lower, or maybe at the same price you sold, right? So yeah, listen, Nvidia, again, is the biggest company in the world. You can't be the biggest company in the world and not have competitive threats. If you're winning in something, everyone wants to go after you. And I just look at, okay, what are they doing now? What are they focusing on? Robotics is a huge part of that. So if Nvidia is going to continue really killing it, it means that they're going to be right about some of these longer term bets that they're making. And if robotics makes up a significant majority of that, I would say like the two biggest parts are basically robotics and like power and energy for the data center, right? Nvidia is obviously super invested in making sure that the grid and the efficiency can match their chips that they're making, or else they're not going to sell as many chips. And then they're concerned with the like AI becoming more ubiquitous in the real world. If they're right about those bets, Nvidia will go up. But my thing is, I can probably find a bunch of other companies that'll go up too.
That makes sense. But they also are first of all, what is for some reason I forget. It's training and then inference, right?
Training and inference, yeah. People talk about them as if they're two different things, but they're very like intermeshed. The more you train, it's not like 0 or 1. It's like they're both happening at the same time. They're both a function of the same kind of curve. But yeah, that's the main thing. I have something that would be interesting to do.
Yeah.
If you remember, I think the most well-received podcast we did was on our 25 trades for 2025.
Yeah, that's the last one we did. Yeah.
Okay, so I'm going to be the podcast guy now for a second.
Sounds good. Take it over.
Okay, without looking, I can see you on the screen, so I can see whether you're reading. I'm interested in because now I have we just launched this thing called Citrindex.com, which is you can go. It's a whole library of every basket that we've created. So you can go and you can see every single trade from 25 trades for 2025. You can see how it's performed and everything. So, without looking, what would you say the 2 or 3 best performing of our 25 shots in the dark from December are now that we're halfway through the year?
I would say short home builders.
Okay. It's okay if you can't think of another one.
Yeah. I don't know.
Okay. Yeah. I like something that
maybe drones.
Okay. Yeah. So that's for me, when the process of there's 2 things that happen when you're doing this kind of basket approach, right? Your first priority really should be, does this basket actually, because if you're approaching every basket and just, hey, I just want this line to go up, they all start looking the same. And you got a lot in the ETF world where it's every single ETF has a massive position in Nvidia. And you're like, yeah, I mean, I guess I can see it, but also maybe they're and so when I create a basket, my first kind of priority is making sure that it captures the actual thing that it's trying to capture, which means that if the thing doesn't happen, the basket should go down. So it's always interesting for me to go back and look at these trades for the year forward and think about, okay, what actually happened and how are the baskets performing. So the housing shorts did do well. I think that is.
Hold up, the housing shorts, when you posted about it a few days ago, home builder shorts were up 5%, but again, that's a short. So up 5%. Right. For a long is not that good when the market's up 20%, but for a short, that's very good.
Yeah, exactly. And the best performing 2 are the electronic warfare counter drone names. So that I'm pretty satisfied with that, because if you think about what were some of the biggest things that happened this year were okay, you had the trade policy in the market, at least the trade policy stuff. And then you had the U.S. bombing Iran and nothing happening. But that was, we called that a war from home, which is like the new WFH, because these are 3 countries that are 1,000 miles or more away from each other. There's no boots on the ground anywhere, but they're fully engaged in a conflict. So yeah, the counter UAV basket is the best performer. It's up 50% year to date, or since inception. And then the one right below that is the trades that we had on normalization of Ukraine and Russia. That's up 47%. So what do you think the worst performing ones are?
So before this, I looked. So I cheated looking at it before.
You got an informational edge, but let's see how your memory is.
I don't think that the passive electrical components did that well. And those are some of the things that you see people are talking about. So a lot of the components that some of which are maybe involved with industrial automation and maybe robotics haven't done that well. I don't know. There was a macro trade that didn't do well. I don't know. I'm gonna go cheat.
The passive components actually did end up doing well. It's up 15% since inception, which is beating the market. That was the interest. That's why I just have to wrap the circle, because a lot of times when this is, again, that article is we preface it with just half of these are going to be wrong, because that's and we're letting that be okay. And it just the value in it is just having this watch list. So I feel like I spoke about it on your podcast. That this was the only podcast that I did on that. So I want to make sure your readers are updated in the sense that the value from this is just having a good watch list of themes throughout the year. And so passive components was doing very poorly, and then recently bottomed with the kind of economic concerns of the tariff impact, and then absolutely ripped off the lows, right? It was down pretty significantly. So let's see what it was doing year to date. It was down at the bottom. It was down 30% year to date, and now it's up 14%. Pretty significant comeback, and that was part of the signal for me to start looking into what exposures are driving this. Is the auto cycle turning? Is there a automation angle?
And so am I right that there is a lot of overlap between passive components and automation and those there
is overlap in a certain area, which is kind of the motion control and the lagging edge semis aspect. That only makes up about 10% of our automation basket, but there is overlap. And also in terms of just sector-based exposure, there's a ton of overlap, right? Because the biggest kind of customers for automation are besides, it's basically the automotive supply chain. So they're exposed to similar areas. So yeah, so the two worst performing, which I thought were interesting, are remittances, right? That was one where I guess that was going out on a limb. It was basically like, oh, if people are here and there's like a push to curtail immigration, people will be sending more money home because those people won't be coming into the States. What that failed to consider was obviously that if people are afraid of getting deported, they're not showing up to work, so they're making less money, and that means less money being sent home. And also probably some degree, I don't know what level, but of like stablecoin adoption in emerging markets. I think that also negatively affected it. So that was the worst performing of them. And then the second worst was
rare diseases.
Yeah, which I think actually is probably, so that basically has been a function of obviously like biopharma, biotech has been blown out by rates. And then also there's been a big kind of negative focus on RFK and like the FDA's approval process. I think that's way overblown. If I was going to guess like an area that kind of would like stage a kind of black sheep comeback moment, dark horse would probably be rare diseases, because you're seeing like gene editing has been ripping pretty significantly. A lot of this focus on, I think RFK just sent out a tweet where it's like MAHA, Make America Healthy Again, also includes MABA, which this is
It's like right to try. If you have a lethal disease, you have a right to experimental treatment. That kind of thing.
I want to say that MABA stands for Make America Biotech Again, but I feel like that's wrong.
Make American Biotech Accelerate. MABA.
There you go. Okay, I was close. Yeah, that kind of FDA approvals are actually going up year over year. So that could be an interesting kind of dark horse come from behind candidate.
Yeah, and for people who don't know, medicine and medical stuff, that is in your wheelhouse. And you also were very early on Ozempic and the GLP-1s, Novo Nordisk, Eli Lilly. I should listen to the Charlie Munger advice and put many things in my too hard bucket, but I am much too ambitious, like many people. But one of the things that I do put in my too hard bucket, which definitely belongs there, is biotech. So I'm like, I just have no idea whatsoever.
Yeah.
But James, talk to us about health insurance. AI is going to transform into phase 2 robotics. We're going to talk about that much more. But healthcare, finance, as you said, advertising. The healthcare names are getting slaughtered. So the healthcare ETF includes many different types of things, not just health insurance. But if you just look at the health insurance basket, United Health, Cigna, most notably Centene, these names are getting absolutely decimated. And insurance is a business that at least I can attempt to understand. Health insurance, first of all, I had no idea, James, that over half of Medicare and Medicaid was administered by private companies. So I just didn't know that until recently. And James, to me, these names look bombed out in the cyclical area. There's a reason why they're bombed out. The big beautiful bill cut Medicaid and various Obamacare stimulus measures as well. But the issue to me, James, is even though to me it looks attractive, these Centene, United Health, everyone I know who actually understands healthcare, like you, Eric Packman, who I interviewed recently about the U.S. healthcare system. He used to he's a founder of a pharma company, as well as some random guy I DM'd has been DMing with me on Twitter about.
I love random guys on Twitter.
The healthcare is really messed up. They say not so fast. So what is your view on the health insurance industry, which is loathed by a lot of America, perhaps justifiably so, and is also loathed now, which is new, by the investment community? And it appears there are a lot of headwinds, talk about the one big beautiful bill, but why are you not bullish on this? And why am I wrong to be bullish?
I am going to pretty much defer to your guest, Eric, was it, right?
Packman, yeah.
Yeah, pretty much agreed with everything he said. As far as health insurance goes, I think that what I focused on more is medical devices, just because part of the administration's posturing, at least, is that they're anti-big pharma-ish, and medical devices are a way around some like pharma interventions. But medical devices have outperformed. If you do the IHI XLV ratio, you can see the outperformance. Also the kind of like crisis in health insurance does present opportunities elsewhere, especially in like small cap healthcare has gotten completely steamrolled. The thing that Centene cited as like one of their bigger negative factors were the cost of very expensive treatments like cancer treatments in markets like Florida. So there used to be kind of like this fad in like value-based care, and there's only like basically one value-based care company that's still public. I think it might be too small to talk about on a podcast. We've spoken about it at length, and they are definitely beneficiary of this kind of like trend that's become a crisis for health insurance. All the headwinds that Eric talked about, I totally agree with. But there are some interesting areas. Something that I've been toying around with recently, as you might know, I've definitely spoken about this with you. We have had on and off our GLP-1 kind of long short basket. And the short side, the long short pairs were very focused on the second order impacts of GLP-1 therapy. And the interesting thing about second order impacts is they act with kind of a delay. There's a bit of a lag where the first order impacts happen first. Surprise, surprise. But we really, 40% of this GLP-1 basket on the long side was Novo Nordisk and Eli Lilly. I think it was back in November. They performed very well, and we decided to take it off. Not because we turned necessarily like super bearish on GLP-1s, just because the kind of first order stuff had significantly outperformed, and it was probably time for it to take a breather. And it wasn't yet time for these second order impacts to make themselves really known. Some of them had, although they were helped along by other kind of secular trends, like, for example, we were short alcohol stocks in there. Gen Z's not drinking, but GLP-1s also result in lower alcohol consumption. But now that we're seeing kind of like this critical mass of users on GLP-1s, it's become very, I remember when we first wrote the GLP-1 primer, there was this big, I was like, guys, can you believe it? Like they mentioned Ozempic at the Oscars. And now it's like, you can like Ozempic is all over social media. There's entire social media communities about GLP-1s, and it's been helped along by the gray market. And so looking at the environment now, I get a renewed interest. First off, I think Lilly should be a $1 trillion company. I don't know if you're familiar with their pipeline, but they recently revealed their phase 2 results on a combination drug of tirzepatide and bimagrumab, which is a GLP-1 GIP drug similar to Ozempic, combined with a monoclonal antibody that is a myostatin inhibitor. So in English, that's basically like you have a drug that's preventing you from having an overactive appetite, and then you combine it with a drug that's going to prevent you from losing muscle due to caloric restriction. So essentially, Lilly is trying to create the cure for not being jacked. And if you look at like the phase 2 results, people lost 10% of their body weight, but gained 5% in lean muscle mass. And I don't care who you are, everybody probably wants to lose 10 pounds and gain 5 pounds muscle.
I'm interested in that.
Right? so that's going to be crazy. The other interesting aspect of that is there's been a lot of discussion about the impact of this like gray market, hims and hers, peptides on the kind of secondary market acting through this. Peptides are super cheap to produce, but it's not monoclonal antibodies. So if that becomes like a standard of care type thing, which I don't know if it will, but maybe it'll be much, much more difficult and pretty much impossible for the gray market to basically keep up there. But the interesting thing with GLP-1 adoption becoming more ubiquitous over the past 3 or 4 years, now you're starting to see areas where I expected there to be second order effects, but they were overpowered by more kind of cyclical downturns or healthcare kind of drama. One interesting area is aesthetics. And this is something that I've spoken about a little bit. I've played on and off through different areas, but I've been tracking like the Google trends of aesthetics, terms like skin tightening, abdominoplasty, facelifts. There's something now called Ozempic face, which is like when you lose a ton of weight, fat kind of fills out your face and then the skin doesn't rebound as quickly. And aesthetics, med spa industry has been totally bombed out, and now they're coming off a super low base. They have very easy comps, and that's one area where second order effects are showing up. Another one, I think I've played it to varying degrees. It worked very well in the beginning. I got out just because I didn't want to fight with the various swings and interest rates, but I'm still pretty bearish on CPAP machines and sleep apnea treatments. And so yeah, I've been kind of in healthcare.
What does that have to do with interest rates?
Well, I mean, medical device companies are like, go compare like a chart of like Dexcom or ResMed to like rates. They're just very capital intensive companies, and they're very sensitive to interest rates. So you do not want to be short like a basket of medical device companies at the same time that rates are rallying.
So it's like real estate,
basically. So yeah, I think now it's getting more interesting. I'm getting more. We recently just put back on a selection of some biopharma companies. It's always interesting because you really have to preface it with, hey, here's 10 names, a couple of them are going to die. The ones that don't, if they make a 10x, it's going to be great. So that's basically how I play biopharma, at least. But yeah, I think the interesting thing around healthcare is just it's that classic, like, you're waiting for the period of time where nobody's paying attention to it and interesting kind of inflections start happening again. And that can take longer than you expect, but it's not like we're getting healthier as a nation or like diseases are going away. We're still making massive strides in cancer treatment, in endocrine. So I would just say it's an area that we should continue to pay attention to, and that I am.
So you said we're not getting any healthier, but we're also making medical strides. Tell us how both of those things are true at the same time. And then also, isn't it the case that Ozempic could lower the cost of medical care because if there are fewer obese people or they're less obese, then the health insurance companies have to pay out fewer stuff? Or I think I actually first heard you say that theory on the Odd Lots podcast when you went on there in 2023. But I don't know if now I'm the one saying it, not you. So I don't know.
That's like that really plays into the idea of timing, like second order impacts, where it's like in the beginning, these drugs are super expensive, and that kind of hurts margins for health insurers if they decide to cover it. And also, you have to get past the thing of like, if health insurers have to decide to play the long game, which they're really not in a position to do right now, but basically play the long game in terms of getting people like covering these drugs for weight loss. And then you get the benefits down the road of people require less treatment for diabetes or congestive heart failure or even like knee osteoarthritis, anything that comes as a impact of long-term obesity. So that's it. Really, it's like, as long as the health insurers are refusing to cover this stuff, they're not really gaining the long-term benefit because it entails this kind of short-term pain. And there are plenty of insurers that have taken hits on these more expensive treatments, like I said, and that's kind of part of the reason why this gray market has flourished, right? But we're seeing like Lilly has their Lilly Direct program where you can pay out of pocket, and I think it's like $500 a month. It's still out of reach for the majority of Americans or people in the world. The real thing that would supercharge the kind of second order effects and again take a big burden off of healthcare costs in the US would be like an oral GLP-1 drug, just because it's so much cheaper to make. Pharmaceutical companies are very good at making pills. And the margins are already very high on this stuff, but would be crazy, and costs would be able to come down significantly once they get an oral preparation. That's again another tricky kind of scientific thing. I don't know if this is like scientifically true, but in general, I think endocrine drugs, when they're taken orally, have more side effects. So
as someone who's never taken steroids but has seen a few YouTube videos about it, yeah, I think it's true about steroids.
Yeah, it's totally anecdotal. Someone will prove me wrong with like data, I'm sure, but that's like my general feeling. I think that mid-cap biotech still trades relatively cheaply, and there's a lot of near-term catalysts from regulatory, clinical, business development stuff. We're seeing acquisitions pick up. You saw the Verona acquisition. And I'm focusing on this area just because it might suck for a little longer, but it's not going to suck forever.
And what would you have to see for you to become bullish on the health insurance names and like United Health, for example?
I'm not touching health insurance. You spoke about the too hard basket. In my too hard basket, right? Like the interesting thing is just the best time to get long health insurers was when Obamacare was passed. Like health insurers are a big time regulatory arbitrage. It's just like they play off the regulatory environment. You can really go deep into, okay, well, Centene's more exposed to the marketplace and this, that, and the other thing. But for me, it's just not worth it right now because the entire healthcare sector has been neglected. So there are opportunities where I have to be confident on a lot less stuff than I do in health insurers.
James, I want to end with robotics where we began, but first let's talk about other beneficiaries within the AI phase 2 flywheel, what you call the data flywheel, about companies that's got proprietary information sources, proprietary advantage, hard to replicate UX, companies like, I guess, CoStar, MSCI, Netflix. So the idea is MSCI, the actual work of doing indexing is you require fewer humans, but what's still valuable is the brand. And S&P, for example, like your S&P, the ratings agency has always been a very high margin business, but it could get even higher margin because it requires less human labor. But what's still valuable that S&P provides it's not becoming commoditized, because what everyone needs is, oh, I'm AAA rated, oh, I'm investment grade rated, and that is not going to go away. And then Google, insurance companies, so other AI phase 2.
The thing about in the kind of non-physical, so non-robotics space of phase 2, the question that you're asking is basically, we have these three kind of, let's say the generative AI opportunity is let's take a bull case, like $1 trillion a year revenue opportunity. And right now we're at like, I don't know, 10 billion, 20 billion. That's going to be split between, obviously you have infrastructure, and then you have the foundational layer, the model layer, the application layer. The application layer is super difficult to play because most of these companies are private, and if they're not, they've probably gotten acquired by one of the Mag 7. So the way that I'm thinking about it, trying to think about it, is that there's been a big focus on agents and agentic AI. I think that if you're taking a long-term approach, the winners here are not going to be the people that are, or the companies that are building agents, but like the ones with the kind of preconditions to make them useful. Like you said, some of these higher margin big data mo companies. The thing about that is, I don't know if you remember like the first AI name to fall on its sword. It was like Chegg, right? Chegg reported earnings, and they made the huge mistake of saying in their earnings call, we saw some drop off because of ChatGPT in our like automated, basically like Spark Notes, like summarization platform for textbooks. It's the same thing on the other side, where it's like companies that are getting a durable kind of margin uplift from the use of AI, they're not going to be shouting it from the rooftops, right? Because they want that to last as long as possible. It's kind of like when you find an edge in the market. If you're a quant, you're not like sharing it with everyone until you're forced to in an Indian court of law. It might be a deep cut. So the way that I'm thinking about it is where, like, if you own the data that matters, if you own the users and the workflows, if AI enables you to reimagine an interface, if you can very easily use middleware and like observability infrastructure and hyperscaler infrastructure that's provided to you to create durable advantage, then you're really positioned. But the thing in selecting these names is you have to look at the ones where you have to pick names that have tailwinds from other areas, right? Because you need to make sure that you're positioning where you own this for the long term because you believe that they will benefit from AI, but at the same time that can take a little period of time. So you want companies that like are encouraged to implement this stuff with specialized proprietary edges that can compound over time. I'm looking at stuff that has a flywheel of a better model means superior user experience. Superior user experience means more users means more data means a better model means a superior user experience. That kind of flywheel thing. One that's, I'm looking at like when to buy the dip on FICO. There's a huge like policy style thing that's going on. I think that'll be pretty interesting when it's time. A lot of these names, like there's a dichotomy of like sleepy ones that like don't seem that exciting from an AI perspective, like Grelk's, basically professional data, scientific data. And then on the other side, there's like names that seem super speculative and are scary to talk about and have taken 90% drawdowns in the past, like Carvana or Robinhood. Or so one of those, like Upstart, for example. Upstart has a pretty significant tailwind from private credit eating the world, right? Just in the sense that like private credit needs more stuff to buy because they've got all this money. And that is probably going to come from consumer ABS, and Upstart is providing those. And Upstart does use AI to underwrite these loans. And so it's just like you're looking at, okay, AI is getting a lot better. Does that mean their underwriting process is getting a lot better? But at the same time, it's Upstart. And I guess in terms of talking about Upstart, I've already gotten edge because I know what they do. That might be another deep cut.
Oh, yeah. Hey, that's good. That's good. James, I got to say, on the Chinese fintechs of using AI to distribute credit and make underwriting decisions is so much better in China than it is.
Oh, yeah. Well,
the delinquencies are probably 10 to 20 times higher in the United States on those types of things. And the Chinese names that do them, which I have been heavily invested in, as you know, James, is, they trade at 4 to 5 times earnings, formerly 2 to 3 times earnings. And interestingly, viewers will know, and one of our first conversations, I mentioned one of these stocks, which I was heavily invested in, and James was like, whoa, that's got a $200 million market cap. And that's close to $1 billion market cap right now. So
nice.
James saved everyone from some big gains there.
My deepest apologies. Yeah, that Really, in financials, that's the most like another one that I've looked at in the US is like Guidewire, which is it's like a PNC insurance suite. It's got embedded like underwriting, billing, claims workflows. Like you just want to look at stuff that's like mission critical, that's sticky, and maybe can add a few percentage points to their margins as AI gets better. That's not like it's not like super exciting. It's not like Stargate investment, $1 trillion, SoftBank. That of course there are like things that you should own there, but at the same time, it's if you are just like a long-term believer in artificial intelligence like I am, it necessitates that you should be positioning for AI to really improve things. And again, we didn't really get into it, but we did go to China to visit all these robotics companies, and the data moat that something like WeChat has is insane. Right? Can you invest on that right now? I don't know. Like China has always been like an anti-US momentum trade.
Oh, WeChat's owned by Tencent, right?
What?
WeChat's owned by Tencent.
Yeah, exactly.
Yeah.
And that's just, you fill out your customs declaration on it. You like hail a ride share. You book your hotel. You chat with your friends. You pay people. It's just like all the data, just all the data. And so that'll be pretty interesting. I think that wrench has certainly been thrown in the gears with the export license restrictions, but we'll see how that plays out. I think it's a qualified statement that those export restrictions have hampered China's AI progress a little bit, which is obviously the intention.
What do you think about the most obvious names? Microsoft, a hyperscaler, Google, a hyperscaler that people say its search business, it's basically close to monopoly. Search business is under threat because of chatbots. It now uses Gemini. What do you think about those two obvious names that dominate the S&P?
Google, I think, is doing a good job in AI, but at the same time, and this is like a thought pretzel that I don't know, maybe if your viewers have comments or something like maybe someone knows this and I don't. I'd still like that experience of going on Google, trying to figure something out. The answer is delivered to me with 0 ads delivered to me in the process. I like pretty interesting. It's like, well, how do these advertisements get delivered? There'll be like training models there's a couple ways you can train models to basically choose certain things over other things. It's really interesting. It's probably a good thing for companies that are like delivering like apps into established or delivering ads into established ecosystems like AppLovin, or probably not good for like the Trade Desk or the traditional advertising firms. If you look like VO, you can pretty much make an ad campaign using AI. So maybe not good for WPP or OMC. But again, I don't know. I don't know how Google gets around this. I don't know how Google manages to not cannibalize its advertising business, but they are doing very well in AI. Gemini is good, and that is an interesting dynamic that I haven't fully cracked yet.
All right, James, as promised, let's end where we began, talking about robotics. I just want to get that story that you told at the beginning there. So there's a company called Teradyne, not to be confused with Teledyne, by the way.
Well, Teledyne also, yeah, like
Teledyne's a conglomerate. Teradyne, I honestly didn't know this until today, preparing for the interview, that they do semiconductor services like checks. That's their main business. And then robotics is their new arm. They made several acquisitions. Amazon, and you've got a chart in there showing the number of workers in per Amazon warehouse, which has been going down, as well as the number of products shipped per worker, which has been going up. So basically, Amazon is getting a lot more efficient, and key to that is robotics. And they recently put out this video, and at the end or the middle of the video, we put the video about their robotic arms and stuff. And you zoomed in on the video, like in large, and you found out that the company was it was designed by, what was the name of the company?
This was with Universal Robots, which is a Teradyne acquisition from 2015, and so we worked on this with investigative journalist Hunter Brook, and it's a pretty big, just like back of the napkin math if you do it on this. First we started from just, okay, the underlying business is pretty solid. It's been auto exposed, but it has upside as that cycle kind of normalizes. But once you get into, okay, how much do these cost? How big is this contract? You think there's 14 billion items. If you consider the Vulcan is dealing with about 80% of items a day, that's 11.2 billion Amazon packages that need to be handled by Vulcan annually. 300 items an hour, 20 hours a day, 365 days a year. That's about 2.2 million items per robot per year. And that translates to about 5,100 Vulcan robots needed across the Amazon network. So as this deployed, you can say the Amazon's Vulcan units probably go to between 150 to 250K. So once you do that back of the napkin math, you assume some discounts for enterprise deals. The reasonable opportunity for Teradyne to add about $400-500 million in revenue, which translates to about $1 in EPS. It's something that the market wasn't really paying attention to. The Universal Robotics acquisition was viewed as a bad move back when they did it, but they've been working with Nvidia for years to integrate advanced AI and vision capability into their cobots. They developed an AI accelerator toolkit that uses Nvidia's Isaac platform. Last year they demonstrated like a new autonomous inspection robot and they have a ton of upside from going from like grippers to dexterous hands as that cost curve kind of deflates, which is part of what we learned in China. There's a big cost competition going on in China with a lot of kind of upstart companies. And so that is if you look through the cyclicality, the business exhibits substantial secular growth through the long term. It's got strong execution, strong management. It's gained market share in memory tests throughout the down cycle. They have a nascent business providing testing equipment to custom ASIC players like Marvell and Broadcom. So good underlying business, big robotics tail, underappreciated by the market, and that was the story. And that's basically it. And then we wrote a bunch of other stuff about different areas in the robotics chain, but you can check that out on our website.
And just full disclosure, Teradyne is a member, I checked, of the VanEck Semiconductor SMH ETF, so disclosure on that. And also because I read about Teradyne today, I did buy one call option, but it wasn't just because, Citrini wrote about it. I looked into it a little bit, and it is a profitable company that, as you noted, didn't have that much debt, and they have done a lot of share buybacks. So we'll see if it works out. James, when it comes to robotics, in that piece that you just published for the Citrini Substack, you mentioned like 50 companies many of which I'd never heard of, almost all of which I hadn't heard of, and some of them which were Chinese. Which are your favorites for your non-Teradyne robotic stack? And then also I want to hear about your vision to China, just a little bit more color on your visit to China, and also why have you been a seller of Chinese equities? Because I get your Citrini notification, so I know that you've been a little less bullish on Chinese equities. As someone who's been quite long Chinese equities, I want to know why.
So went to China, visited probably the coolest one, and you can see the videos on the website of like Unitree with their robot dog, super advanced, super capable. It's very clear that China's caught robot fever. There's a bunch of manufacturers that have replaced international suppliers in mature industries already, and they see robotics as this kind of massive new market opportunity that they're eagerly pursuing. We have some pictures of you walk into these companies, and the first thing is they have like big stylized posters of humanoid robots. And a lot of these companies have outperformed pretty significantly over the past, since last September, there was a big World Robot Conference in Beijing, and they've outperformed pretty significantly. But as we went and visited, there's a couple different models that the OEMs for humanoids are pursuing. You have like UB Tech trying to develop this full stack AI solution like Figure AI or Neo. And then you have Unitree, which is basically taking the approach of we're going for impressive hardware. We're not focused on the brain. The brain, you can slot in your own brain from an Nvidia chip or whatever. And we're just focusing on the hardware, and all our suppliers are within a 90-kilometer radius, and you can buy these for very cheap, right? We bought a Unitree robot dog for about $4,000. And it's so the takeaway really is like in the supply chain, they're still pretty concerned about the auto cycle. They are a few of them are definitely leaning into industrial robotics, but there's also just like this race to the bottom in terms of cost competition. So it's a little bit of a juxtaposition of you go there, the pony AI like robo-taxi rides are absolutely flawless, but at the same time, you can still see a little bit of the weakness of consumption that's recovering. I think I basically sold down some of the China stuff just because I anticipate more kind of volatility. I replaced a little bit of it with like upside options. It's a difficult environment right now. There was a lot of like significant outperformance from when nobody wanted to own China. I would definitely get back in, but we do need a little bit more clarity from the macro level. There's still some pretty significant headwinds affecting China. And the other thing is China has acted as one of the things that we said in 2023 was Chinese equities have this like anti-momentum factor to anti-US momentum, where when the US is ripping, it's like easier for people to just feel comfortable owning Nvidia, and it goes up every single day. And those attractive valuations in China, which have expanded in some cases without like or earnings expansion. So it's more difficult for people to underwrite that. I think that in order for me to get big in China again, it would probably require a little bit of like sideways performance or like less exciting performance in the US or in the EU. But something that's interesting, I've played at various points over the past 4 years, like Chinese property companies. I think that there might be a reasonable opportunity in some of these Chinese property servicing companies. I'm looking. It's early.
Servicing companies, so not the real estate companies themselves, but the servicing companies.
Exactly. Yeah. In a lot of cases, like there's like nets with cash greater than market cap, no debt, growing earnings, but just the valuations are completely bombed out. Nobody wants to touch them. That's how China used to be broadly. And now there's been some expansion in China. And don't get me wrong, there's still great opportunities in China, but I'm still looking to get paid for the contrarian aspect, and it might be time for that. As I won't go too into it because I haven't done a ton of work yet, but that was one of the takeaways. Is those might be interesting now.
And you said you had 3 minutes on tariffs. Final question for you, James. Tariffs. It's the stock market seems to not take the tariff threat from President Trump very seriously. But as we record, he announced a 50% tariff on Brazil, despite the fact they're a surplus country, a 50% tariff on copper that will go into effect on August 1st. He seems a little bit more serious than the stock market maybe thinks that he is, at least to me. What do you think? And do you think that this is a threat to the bull market?
I think it's a reasonable thing to own protection, but I will care about it when the market does. I figured that that's like kind of a cop out. Maybe I said 3 minutes and I meant 3 sentences, but the fact is the market is deeply ingrained in this like taco trade. Could that be a false sense of complacency? Sure. But when it like you can't really, I think it's worthwhile to be cautious and pay attention and own some downside protection. But as far as like getting into the realm of selling out of things, there's a lot of positive tailwinds for the US. You don't want to, everything that's announced will go into effect on August 1st. And it's okay, that's 3 weeks from now. And that's a huge, like, that's a lot of opportunities for this to end up being not bad. So I think the Brazil thing, it could definitely increase inflation. If it goes through as fast, but it's the same thing as like the chart, right? It was like, if this goes through, the US is, and it's totally unchanged, the US is for sure going into a recession. That table that he brought out on Liberation Day. And then the market like had a conniption, and stocks went down at the same time the dollar went down, at the same time the bonds went down, and then it changed. We'll see. I don't have a super strong view. I'm definitely not ignoring it because that seems like a good way to get yourself in trouble. But I'm waiting until the market cares. That's the most straightforward I can be about it.
That makes sense. Thanks so much, James. People can find you on Twitter at Citrini7. Your research platform is citriniresearch.com. Tell people what subscribers get in terms of the articles, in terms of the updates, the Citrini index, the trades, but also this new platform, which, to be honest, I haven't checked out the new platform of, did you say it's citrindex.com, where you get live updates and everything so you can track it? Tell me about that.
Yeah, so it's basically, I find a lot of use in it. It's because there's only so much bandwidth you can have and only so many things you can focus on. It's sometimes easy to have these themes, and even if it's a great theme and you get out of it for a gain, everyone's experienced the concept of they own a stock, it does really well, they sell it, and then they look at it again in 6 months and it's, oh, I forgot about that one, bottoms, and then it rips. We basically created citrindex.com to provide a centralized area where you can look at every single basket that we've ever created. You can sort them by performance. You can sort them by attribution on a single security level. You can search through them to see which securities are in there. We keep old baskets like things that we've spoken about, like our bank long short strategy or our insurance long short strategy, or any of these various baskets that we've created over the years. You can go, you can look, you can see how they're performing year to date or recently. And you can see all the macro trades that we have on. There's alert functionality for when we change baskets or when we change. So it's like it's added function if you're interested in thematic kind of performance tracking. You should definitely check it out. And then if you want to get the research, you can check out citriniresearch.com. We have all our stuff on there. We just published this update, which is pretty comprehensive. I would say it's one of the more comprehensive updates we've ever done to a theme. And there's a lot of really interesting stuff in there, from our trip to China and our kind of investigation into this Teradyne situation. and then a couple early areas of outperformance in this name.
Yeah, a lot of tickers, and some of them have letters, aka American stocks. A lot of them have numbers, aka Shanghai stocks. So if you are interested in Chinese electrical component stocks that no one's ever heard of, that may offer a nice risk reward, yeah, people should check out Citrini Research, and we'll link to that report in the description. Thank you, everyone, for listening. A reminder to check out Monetary Matters on Apple Podcasts and Spotify, and leave a rating and review. It really helps the show. Also, subscribe to the Monetary Matters Network on YouTube. Thanks. Thanks for tuning in. Looking into SMH or SMHX? Head to vaneck.com/SMHjack and vaneck.com/SMHXjack to learn more. Until next time.
Thank you. Just close the door.